the stock market is buzzing with anticipation as traders bet big on a Federal Reserve rate cut despite a hotter-than-expected August inflation report. But here's where it gets controversial. While the latest Consumer Price Index, CPI data, showed a 0.4% monthly increase, beating forecasts, annual inflation of 2.9% stayed within expectations. This mixed bag of numbers has investors convinced the Fed will still slash interest rates by a quarter point on September 17, with some even eyeing a half-point cut. And this is the part most people miss. The core CPI, which strips out volatile food and energy prices, also aligned with predictions, suggesting underlying inflation pressures are manageable. But will the Fed's move signal confidence in the economy, or a desperate attempt to stave off a slowdown? Let's break it down. The Dow Jones Industrial Average surged 504 points, 1.1% on Thursday, while the S&P 500 and Nasdaq Composite climbed 0.6% and 0.4% respectively. All three indexes hit fresh intraday records, fueled by optimism that the Fed's rate cut will act as a tailwind for stocks. Yet the inflation report wasn't all smooth sailing. The monthly CPI jump raised eyebrows, with traders now debating whether the Fed can afford to cut rates aggressively. Jay Woods of Freedom Capital Markets summed it up. A quarter-point cut is a layup, but a half-point cut keeps the door open. Watch the 10-year Treasury yield. If it drops below 3%, the market could rally. But David Rubenstein of the Carlyle Group warned, a 50 basis point cut would scare the market. It would signal the economy is weaker than we think. Meanwhile, the labor market is showing signs of fatigue. Weekly jobless claims spiked to 263,000, a 27,000 jump from the previous week, and the highest since 2021. This, coupled with downward revisions to August job growth, has traders questioning how long the Fed can balance rate cuts with labor market stability. Wells Fargo's Scott Wren noted, companies aren't firing, but they're not hiring either. It's a holding pattern. Could this be the calm before a storm? Or is the economy simply adjusting to a new normal? Not all the news was bleak. Oracle's shares soared to their best day since 1992, adding $244 billion to its market cap after it unveiled a strong cloud growth outlook. The tech giant's rally sent ripples through the AI sector, with investors viewing it as a green light for innovation-driven stocks. Similarly, Klarna's debut on the NYSE saw shares jump 14% after a $1.37 billion IPO, while Opendoor Technologies surged 33.6% following a CEO change. These moves highlight how investor sentiment can pivot swiftly on a single catalyst, yet the broader picture remains murky. Treasury yields plummeted, with the 10-year dropping to 4% as traders priced in a dovish Fed. But what happens if the Fed's rate cuts backfire? Critics argue aggressive cuts could fuel inflation again, while supporters insist they're necessary to avoid a recession. As Chris Zaccarelli of Northlight Asset Management put it, the rate-cutting horse is about to leave the barn. The narrative has shifted from if to how much. So, where do we go from here? The coming weeks will test the Fed's resolve and the market's resilience. Will the half-point cut scare Rubenstein warns about materialize? Or will the 10-year Treasury yields drop ignite a rally? We want to hear from you. Do you think the Fed's rate cuts will stabilize the economy or create new risks? Share your thoughts in the comments and let's debate this high-stakes gamble.